Now, so let's start today's topic with fixed income instrument features. Fine. We have already discussed about fixed income instrument. We are speaking about a bond whereby the investors who are the lenders get fixed interest paid by the company who is borrowing money from them and issuing a security to them. Okay. Because if you want to borrow, you have to like secure, you have to give some kind of security as a collateral to your lenders. Fine, that's understood fact, and we know that. So what are the features of fixed income security? Major type of fixed income instruments are loans. So if loans are given to someone and you charge a fixed interest on those loans from those people, you get a fixed income. Fine. And these are, there are two types of like fixed income instruments here, we can say. One is non tradable, which is nothing but a loan. Okay. Despite they being agreements between borrower and lender, but bonds are also fixed income securities which are tradable securities, and basically these are kind of investments some people make by purchasing them from companies who want to borrow from general public by giving these kind of securities. Okay. So investors in bonds are lending capital, of course, referred to as principal, par or face value. Generally it is $1,000 or $100 in $100 or $1,000 denomination, and they will be paid coupon by the company, which is a fixed interest payment done by the company and agreed by the company as per the agreement between the company and the lender. Now, and this money is used by the companies as capital. So the companies who issue these kind of bonds are corporate issuers. Okay. Loans and bonds are classified as long-term liabilities in their balance sheet. Now, key features that are specified in fixed income security include the following. Issuer. Who is the issuer? The company who borrows money from people by issuing them some security, which are bonds. They can be sovereign national governments, they can be big companies or corporations, local governments like municipal bodies, supranational entities like World Bank, International Monetary Fund, quasi-government entities sponsored by government like national railways, and special purpose entities which are made for a special purpose, for raising funds from the people by issuing bonds to them. And they are these corporations which are SPEs or SPVs are set up to purchase financial assets and issue asset backed securities. That means they are the ones who purchase assets, okay, and securitize them. And that means company transfers all the assets in those SPVs. They securitize those assets and issue asset backed securities to people, which are nothing but bonds which are having the backup of assets. Maturity. Every bond or loan will have a maturity period or tenor, where on that date the company which is borrowing has to repay repay the money to the lenders along with the interest which is agreed as per which is agreed between the company and the or borrower and the lender. But there can be some bonds which have no maturity dates, are called perpetual bonds. That means whole life people will be getting a fixed income. We have already discussed this while doing time value of money. When we did that, we discussed right about perpetuity. You remember maybe Bhargav. Yes. Then principal, par or face value. So par value of the bond is nothing but that amount which will be repaid. So repayment of principal typically occurs at maturity, but debt instruments may specify that principal is paid back gradually over the life of instrument. That is, like if you take a housing loan, you will be paying the money in some installments, and every time whenever you pay an installment to the bank from whom you have borrowed, you will be making some principal, some part of that payment would be having the principal element and some part will be having the interest element. Coupon rate and frequency. Coupon rate on the bond is the annual percentage of, so this is what we have to understand now. The coupon rate on a bond is the annual percentage of its par value that will be paid to bondholders. Let's say it is $1,000 par value of a bond, and this bond pays semi-annual coupon. Okay, and it is 5% fixed. Since it is like 5% coupon, the company has agreed to pay to the lenders. It is semi-annual pay bond, so hence 2.5% we will take, and $25 per month per every 6 months will be paid to the lender. So what did you understand? This is the face value or par value of your bond. Of this, some percentage, here we are taking 2.5%. This will be paid to the lenders. Okay, now let's go forward. Some bonds pay coupon based on variable market rate of interest at the date of coupon payment. What do you mean by variable market rate of interest? See, some bonds are such whereby fixed interest is paid. Some bonds are such where fluctuating or floating interest is paid, and the floating interest depends upon market reference rate. Previously, it was LIBOR. If the LIBOR is increasing, that is London Interbank Offered Rate. Okay, in different countries we have different version of LIBOR. In India, we have MIBOR. So if I say about market interest rate, let us now understand that in details. So some bonds pay coupons based on variable. Variable is something which is not fixed. Market rate of interest, okay, which is prevailing in the market at date of coupon payment. These bonds are called floating rate notes or FRNs or floaters, whereby floating interest is paid. The variable market rate of interest is called market reference rate, MRR, and an FRN promises to pay the variable reference rate. So here the variable reference rate is MRR, right? Let's say that is like 3% plus a fixed margin, let's say 2%. This added margin is typically expressed in basis points. 1 basis point is 100 basis points make it 1%, right? So you like always these are expressed in terms of basis points, which are hundreds of 1%. Okay, that is 1 by 100. 1% is 1 by 100 actually. 1 by 100, hundreds of 1%.
So it's 1 by 10,000.
Yeah, I'll tell this. So basis point generally. So when it comes to basis point, I have already discussed right now. 1/100th of 1%. So if we say this, if you want to know how much is 100 basis points, 100 basis points is equal to 1%, right? And 1 basis point equals to what? 0.01%, or as you said, 1 by 10,000. So 0.0001. Is it right?
Yes.
1 basis points. 1 basis point, if you want to show in percentage, it is 0.01% or 0.0001 if it is not a percentage. And 1% is 100 basis points, right? Now, so how they pay? See, every company wants to, whoever is issuing a bond, okay, they have to pay some additional interest to the lenders based upon the risk factor what they carry, isn't it so? So here also the same thing would be going on. FRN promises to pay the variable reference rate. So MRR is paid, however, that is 3%, let's say, plus a fixed margin. So you know this is fixed, but this is going to change. Am I right? Because it is variable reference rate, it is going to be sometimes 3.25, sometimes 3.5, sometimes 4. Anything is possible, but this is fixed margin, right? So in this way, if it is going 3.5, 3.5 plus 2, it becomes 5.5. So it becomes variable, right? See, the market reference rate is going to vary. That's what they're saying. This added margin is typically expressed in basis points, which are hundreds of 1%. Now, some bonds pay no interest before maturity. They are called zero coupon bond. They are issued at discount and redeemed at par. We already know. So there's an example: a 10-year $1,000 zero coupon bond yielding 7% would sell for a bit more than $500 initially and pay $1,000 maturity. Instead of paying coupon, they are paying you full amount, right? That they are paying you the differential of the amount at which it is issued and the redemption value, which is the face value. That means you understand, right? $500 they'll be paying you in the years till which you hold this bond, that is 10 years. Are you understanding, Bhargav?
Yes, sir.
Seniority. Now seniority is nothing but in event of bankruptcy, what happens, or liquidation of issuers, debt investors, what they do, they claim on issuers assets, and then the ranking comes into picture. So first, the one who are supposed to be paid is the debt holders of the company, right? And that too, senior debts will be paid first, and then the junior debts, which are also called as subordinated debt. Okay. So making senior debt a less risky investment from a credit risk perspective. Senior debts are nothing but the ones on which company has given some guarantee that they will repay, and junior debts are one on which company hasn't given the guarantee, but still if no guarantee is given, no surety is given, it doesn't mean that they are not going to pay. But first priority they're going to give to this, and then the next priority to this. Now that means if some asset is there's a asset backed, then definitely company has to pay, right? Now contingency provisions. A bond may have an embedded option. That means an option which is with the bond while issuing the bond. And that is such as call option, put option, or right to convert the debt into equity, that we will be discussing later. Nothing but the bond. See, company will be issuing the bond with call option. That means company can, buy back the bond at a pre-decided price. Are you understanding? From the lenders. Hello.
Yes, sir.
That they will do when they will do that, when the market interest rate is increasing, right? Because they have to pay more, just a second, when they will do that, when they will think that their liability is increasing. When will their liability increase? When the market interest rate will decrease. Correct or wrong?
Correct, sir.
When the market interest rate decreases, the bond value increases, and more company has to pay more, right? So that point of time, they want to buy the bond at a lower price, and then they will this put option is from the perspective of the lenders. So they can sell the they have that option with which they can sell the bond at some pre-specified price, okay, pre-decided price. These kind of provisions would be there. Yield measures. Now see, already we have discussed about the yield, and we know that there is an inverse relationship between bond yield and the coupon. Correct? When the yield like bond yield and the bond price, sorry, not coupon. So like we know that for a fixed coupon bond, when prices fall, the bond offers a higher yield. Of course, when the bond price decreases, there is an increase in yield to maturity. Okay, and like that's what. If this is high, this should be low, because in the market, if similar kind of bonds people buy, they get high yield. Why will they pay? And company's coupon rate is less. Why will someone pay you a premium price for the bond? They'll pay you less price. Correct or wrong?
Correct, sir.
Yes. The price and yields are inversely related. We have already seen that. We have already done this in the chapter as well. So for a given issuer, we will likely find that bonds of different maturity will offer different yields. Yeah, if a bond is held for longer period of time, you get more yield because of more compounding frequency or periods. So here you can see a graphical plot of these yields versus maturity is referred to as yield curve. An example of yield curve for US Treasury bonds is displayed. So like as 1 month, 3 months, 6 month, 1 year, it's going on, and it's for 30 years. So so what is happening? An upward sloping yield curve, that is higher expected returns for longer dated maturities. Is it right? If you are, this is upward sloping yield curve, right? If the maturity period is like for a very long period of time, you may expect higher returns, right? So a US Treasury exhibited in mid 2018 is referred to as the normal yield curve because this is the shape. This is the shape most frequently observed. Normal yield curve reflects demand for high returns for longer dated maturities due to higher levels of uncertainty. Of course, if the maturity period is very high, that much time the amount is with others, and definitely you may want higher returns to compensate you for taking that higher risk. A downward sloping curve, what does it show? A downward sloping yield curve as US Treasuries exhibited in mid 2023 is less common and is referred to as inverted yield curve. But why this is very less common? Because for a very high maturity, you may expect higher returns, not falling returns, right? Hello?
Yes, sir.
Hello?
Yes, I can hear you.
Bhargav, are you following?
Hello.
Yeah. So there is a downward sloping yield curve also. What does this downward sloping yield curve says? A downward sloping yield curve as US Treasuries exhibited in mid 2023 is less common and is referred to as inverted yield curve. Why? What is this inverted yield curve? As the maturity is increasing, the the yield should be high, right? The returns would be high. If then what is this inverted yield curve?
So because the duration is shorter here, the yield is also less. So
Duration in the sense it is for 20 years.
no, sir, it is for the initial period. So let's say 1 month to 3 years.
No, what happens in case of inverted yield curves? The long-term interest rates drop below short-term rates. That means here the long-term rates are falling, okay, and short-term rates are high. So when short-term rates are high, people show less demand for like long-term, long-term bonds. They show demand for short-term bonds, right? So with this, what will happen? In the beginning, the short-term rates would be high. Isn't it so?
Yes.
Yes. And then what happens? As the short-term rates are high, the long-term rates are less. What will happen? People will be investing in long-term or more short-term? More short-term. So it will be showing an inverted yield curve, right? Generally, the curve should be in this way, but because of the short-term interest rates being high than the long-term interest rates, people are more taking short-term bonds than long-term bonds, and that is showing a inverted yield curve. Correct or wrong?
Yes, sir.
That's what. Now we will just move forward. So I will just write down a point here. Inverted yield curve. This is generally very unusual thing. Represents long-term debt yielding fewer returns than short-term debt. It's very simple. What do you expect from long-term debt, Bhargav? You expect more returns or less returns?
More returns, sir.
Yeah, if that is not happening, then the curve is inverted curve, correct?
Yes, sir.
It's a downward sloping curve. So what is happening is when the short-term rates are high and the long-term rates are less, it reflects bond investors' expectations for a decline in long-term interest rates, which is typically a sign of an impending recession. That means recession is going to come. People, when short-term rates are very high and people are expecting that in future the long-term rates will go down. So what will happen? They will invest more in the short-term debts, right? In the short-term short-term bonds, isn't it so? Then long-term. So they will try to get maximum returns in the with the short-term debts, and that too you see 1 month, 3 months, the returns are high. See, it is increasing. It came to the peak, and then what happens? People they try to exploit this opportunity, and they kind of then what happens, they expect the rates to go down in the future in the long term. So maximum returns they take in the up in this area, and then what happens, it declines. Correct or wrong? That's the reason why it's the inverted curve. Hello.
Yes, I understood.
Yeah, now just a second, Bhargav. You got it right, Bhargav? Inverted curve.
Yes, sir.
Yeah, we shall move forward. So this inverted curves are very important to understand the future of such kind of investments, whether there will be a economic downturn in the future or not. Okay. This shows that recession is going to come. You are not going to get the expected higher returns in the long term, like if the short term rates are very high right now, because long term rates you expect higher returns, but if that is not going to happen, a recession is going to come. And in 2008 financial crisis, this kind of trend was seen. Okay. Now, however, yield curves we are going to discuss in the coming chapters in this particular fixed income subject. So we will be seeing that. Don't worry. Now, government bonds are often deemed to be the lowest credit risk. Everyone knows they have the treasury bonds, right? Treasury bills are for 6 to 9 months. Treasury bonds are for 5 to 10 years. They have the least risk because they have the government's guarantee. Not always. Some countries governments have defaulted on their bonds as well. For example, if a 5-year corporate bond was yielding 6% and 5-year government bond was yielding 5%, then the spread offered by the corporate bond is 1%. Why? Because the difference between the government bond and the private bond is what? Spread. How much this is,
Yes, sir.
how much this is narrow, that much risky the corporate bond would be. How much this is broader, that much like more risky the corporate bond will be. That means the spread here is 1%. So this corporate bond which is offering a coupon of 6% is less risky because it is very near to the government bond. The spread is very narrow between them. It is broader and the spread is, let's say, 5% or 3%. Then this is more riskier. That means that depends only upon this being more or less. Okay. Describe the contents of bond indenture. See, bond indenture is nothing but it is a document which shows the agreement between the issuer and the lender and has all the details about their agreement, what they have agreed, what is the principal amount to be borrowed by the company or lent by the lender, and what is the coupon they are ready to offer, and what is the maturity period, what are the covenants in that bond. Covenants are nothing but the conditions what the lenders keep on the borrowers. Okay. Impose on the borrowers so that they kind of can secure their money, and they can expect like negligible default from the borrower. Source of repayment. The source of cash flows required to be paid by the bond issuer depends upon the nature of issuer and the type of bond issue. Sovereign. See, you understand, governments, they get taxes and they pay the money to the bondholders, and company and local governments are repaid from local government taxes or revenue from operational infrastructure such as toll and roads. We know this. And sources of repayment for corporate bond on type of bond issue, a secure depend on the type of bond issue. A secured bond, see, that has backup, is repaid from the operating cash flow of the company, very simply understood, with added security to legal claim. That means people who have this secured bonds, if they don't get their money, they can claim the money legally by pressurizing company to sell the assets and get and pay them back. Unsecured bonds, they only pay from operating cash flow, but there's no such security what they provide. Asset backed security, there are two things, MBS and ABS. MBS is mortgage backed security. This is asset backed security. Mortgage backed security has all the mortgaged assets backup. ABS has the backup of credit cards, car loan, like documents, etc. We'll discuss that later. Bond covenants are very strong, like restrictions on the company to borrow additional, to raise additional debts until unless the old debts are repaid. So there are two types here. Affirmative covenants specify requirements the issuer must fulfill. These may require the issuer to provide timely financial reports to bondholders, specify the use of proceeds from bond issue, how they are using the money, specify bondholders' right to redeem at premium to par if the issuer is acquired in a merger or takeover. Two examples of affirmative covenants are cross default and pari passu provisions. A cross default clause states that if the issuer defaults or any other debt obligation, the issuer will also be considered in default on this bond. That means if they default any loan, they will be considered default for the current borrowings also. Pari passu clause states that bond will have the same priority of the claims as the issuer's other senior debt issue. That means no junior, no senior. Every debt has the same priority of claims. That means they have to repay everyone. Yeah.
So your screen is stuck, sir, but I'm following.
2 minutes. Can you see now, Bhargav?
So I can see your screen, but it's not moving.
I got then.
So anyway, you can continue with the lesson. I have the book with me.
Yeah, because it's like, only one paragraph is left over.
Yes, sir. Yes, sir.
So pari passu, you understood pari passu? Everyone will be having the same priority when it comes to claim. Okay, no seniority, no junior. Negative covenants,
Okay, yes,
restrictions on the issuer to take any additional loan, or they will ask the issuer to maintain some interest coverage ratio. Entering into asset sales and leaseback agreements, they will not allow company to sell the assets of the company or take any property on lease. Pledges of collateral, company cannot use the same assets to back several debt issues simultaneously. They cannot use the same asset to again show as a backup for more loans. Issuance of debt that ranks more senior than existing debt, referred to as negative pledge clause. Negative pledge clause is what? Issuance of debt that ranks more senior than existing debt. This is what also they restrict. They don't want companies to issue the debt that ranks more senior than their existing debt. Okay, that means company will say no, we will pay you before those old loans, and they try to raise the finance, but they can't do that because there is a covenant here, condition here. And additional borrowing, share repurchase, dividend payments. So they will stop company from doing this and this. These actions can be subject to an incurrence test relating to financial ratios. They'll check companies' ratios and they'll decide all. Negative covenants protect interest of bondholders and prevent the issuing firm from taking actions that would increase the risk of default. However, covenants must not be so restricted that they prevent the firm from taking advantage of opportunities or responding appropriately to changing business circumstances. Because too much restrictions can also be deterring company from raising finance and flourishing or doing their business with ease. So we are done with this chapter, Bhargav, the first chapter. Hello.
Yes, sir.
We are done with the chapter 1. So shall I send you the PDF of this?
Yes, sir.
You want me to take one more class or done enough for today?
That's fine, sir. That's okay for today.
Sorry.
It's fine, sir. For today, it's done.
Okay. So because it's upon you to absorb, right? So I don't want to put pressure.
Yeah.
So I'm just closing this and I'll send the PDF of this to you, and
Okay.
we'll see tomorrow's availability. You just send me
Okay.
the PDFs, what is left over. I'll send all them today. Okay.
Okay, sir.
Okay, Bhargav then. Thank you. Good night. Bye bye.
Okay, sir. Thank you, sir. Good night, sir.
Good night, dear. Bye.